Preparing for a financial analyst at Iberdrola interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How would you analyze Iberdrola's financial statements? I would begin by separating the income statement, balance sheet, and cash flow statement. The income statement explains profitability, the balance sheet shows invested capital and funding, and cash flow tests whether earnings convert into liquidity. For Iberdrola, I would connect operating performance to network assets, renewable generation, capital expenditure, debt, and financing costs. Then I would assess trends, margins, leverage, and cash conversion together rather than relying on one metric. While answering, focus on linking the income statement, balance sheet, and cash flow statement, then connect profitability, capital expenditure, debt, renewable generation, regulated networks, liquidity, and trend analysis. Question 2. Which financial metrics would you monitor most closely for Iberdrola? I would monitor EBITDA and EBIT for operating performance, operating cash flow and free cash flow for funding capacity, and net debt to EBITDA for leverage. I would also track capital expenditure against plan, return on invested capital, renewable capacity additions, and regulated network growth. Segment analysis matters because networks typically provide visibility, while generation and supply can be more exposed to prices, weather, and power market volatility. Together, these metrics show both performance and financial resilience. Make sure to cover EBITDA, EBIT, operating cash flow, capital expenditure, free cash flow, net debt, leverage, return on invested capital, regulated asset growth, renewable capacity, and segment performance. Question 3. How would you build a financial forecast for Iberdrola? I would forecast Iberdrola by segment rather than applying a single group growth rate. For networks, I would model regulated asset growth, allowed returns, tariffs, and inflation. For renewables, I would forecast capacity, utilization, generation, realized prices, and operating costs. I would separately project supply, corporate costs, capex, debt, interest, and taxes. Finally, I would compare outputs with historical performance, management guidance, and downside scenarios involving weaker prices, delays, or higher rates. In your answer, talk about segment-level drivers, installed capacity, generation volumes, power prices, tariffs, inflation, operating costs, capex, financing, tax, scenarios, and reconciliation to historical results. Question 4. What is the difference between EBITDA, EBIT, and free cash flow? EBITDA measures operating earnings before depreciation, amortization, interest, and tax. EBIT deducts depreciation and amortization, so it reflects the cost of consuming or allocating asset investment. Free cash flow starts with cash generated by operations and subtracts capital expenditure, with definitions sometimes adjusting for interest, taxes, or asset disposals. For Iberdrola, significant renewable and network investment means EBITDA can look strong while free cash flow remains pressured during an expansion cycle. Be sure to mention operating profitability, depreciation and amortization, capital expenditure, working capital, taxes, interest, and why cash generation can differ materially from accounting earnings. Question 5. How would you evaluate Iberdrola's capital expenditure program? I would split capex into maintenance, regulated network investment, and growth projects such as renewable generation. For each project, I would test expected returns, construction timing, useful life, funding requirements, and sensitivity to power prices, inflation, interest rates, and delays. I would compare actual spending with budget and assess whether new investment expands earnings and cash flow appropriately. The key question is not simply whether capex is large, but whether it creates risk-adjusted value. Focus on growth versus maintenance capex, project returns, construction timing, financing needs, regulated assets, renewable pipelines, execution risk, inflation, and whether investment supports sustainable cash flow growth. Question 6. How do regulated networks differ from renewable generation in financial analysis? Regulated networks generally offer greater revenue visibility because returns are linked to an approved asset base, tariffs, and regulatory frameworks. Renewable generation can provide long-term contracted revenue, but exposed volumes and prices may vary with weather, market conditions, and project availability. I would therefore analyze networks through rate-base growth, allowed returns, and regulatory decisions, while assessing renewables through capacity, load factors, realized prices, PPAs, and construction execution. That distinction affects both forecasting and valuation. In your answer, distinguish regulated returns and asset bases from merchant price exposure, explain revenue visibility, utilization, tariffs, development risk, and the different valuation implications for each segment. Question 7. How would you assess a new offshore wind investment? I would first validate the project's technical assumptions, including capacity, expected load factor, construction schedule, grid connection, and operating costs. Then I would model revenues under contracted and merchant scenarios, incorporating PPA pricing, escalation, curtailment, and power price sensitivity. I would calculate project cash flows, debt capacity, NPV, IRR, and downside cases for delays, cost overruns, lower generation, and higher rates. I would approve it only if returns compensate for development and execution risk. Cover development and construction costs, expected capacity factor, power price assumptions, PPA terms, operating expenses, financing, permitting, grid connection, sensitivity analysis, and return thresholds. Question 8. Walk me through a DCF valuation of Iberdrola. I would forecast revenue, operating costs, taxes, capital expenditure, and working capital to derive unlevered free cash flow. I would discount those cash flows using a WACC reflecting business, country, and financing risk, then calculate terminal value using a perpetual growth rate or exit multiple. After discounting, I would subtract net debt and adjust for non-operating assets to reach equity value. I would present sensitivities because terminal value and power price assumptions can dominate the result. Make sure to cover operating forecasts, unlevered free cash flow, WACC, terminal value, net debt, non-operating assets, scenario analysis, and the importance of segment-specific assumptions. Question 9. How would you estimate Iberdrola's WACC? I would estimate the cost of equity using the risk-free rate, an appropriate beta, and the equity risk premium, supported by comparable utilities. For debt, I would use Iberdrola's marginal borrowing cost or relevant bond spreads, adjusted for taxes. I would weight both using a target capital structure rather than a temporary market mix. Because Iberdrola combines regulated networks, renewables, and supply, I would challenge whether one group-wide WACC fairly captures each segment's risk. Discuss risk-free rates, equity risk premium, beta, comparable companies, capital structure, pre-tax debt costs, tax rates, country risk, and differences between regulated and merchant businesses. Question 10. What is the importance of power purchase agreements in Iberdrola's business? A PPA can make renewable revenues more predictable by setting a price, volume framework, and contract duration with a buyer. I would examine the counterparty's credit quality, escalation clauses, shape and volume risk, curtailment, imbalance exposure, and remaining term. A PPA may support project financing and reduce merchant risk, although it can also limit upside if market prices rise. I would therefore compare contracted economics with uncontracted scenarios when valuing the asset. Explain contracted revenue visibility, price and volume terms, credit quality, duration, escalation, imbalance risk, merchant exposure, accounting considerations, and how PPAs influence project financing and valuation. Question 11. How could International Financial Reporting Standards 16 affect analysis of Iberdrola? International Financial Reporting Standards 16 generally brings lessee leases onto the balance sheet through a right-of-use asset and lease liability. The income statement then records depreciation and interest instead of a single operating lease expense, which usually increases reported EBITDA but also increases debt like liabilities. I would adjust leverage and valuation comparisons consistently, distinguish lease payments in cash flow analysis, and avoid interpreting higher EBITDA as purely operational improvement. The treatment matters when comparing utilities with different leasing structures. While answering, explain lease recognition, right-of-use assets, lease liabilities, EBITDA presentation, depreciation, interest, cash flow classification, leverage metrics, and comparability across companies. Question 12. How would you test an impairment charge on a renewable asset? I would identify the relevant cash-generating unit and assess indicators such as weaker power prices, project delays, cost inflation, underperformance, or regulatory changes. I would compare carrying value with recoverable amount, based on value in use or fair value less disposal costs. Key assumptions would include generation, prices, operating costs, remaining life, and discount rate. I would run sensitivities because modest changes in long-term prices or discount rates can materially alter impairment conclusions. Cover cash-generating units, triggering events, recoverable amount, value in use, fair value less costs, discount rates, long-term prices, capacity assumptions, and sensitivity to downside scenarios. Question 13. How would rising interest rates affect Iberdrola? Rising rates can increase interest expense on floating rate or refinanced debt and raise the discount rate used in project valuation. They may reduce the NPV of long-duration renewable assets and make new capex less attractive. However, regulated frameworks may eventually allow returns or tariffs to reset, and hedging can delay the income statement impact. I would quantify debt repricing, maturities, hedge coverage, and project sensitivities rather than assuming every rate increase affects earnings immediately. Discuss refinancing costs, floating rate debt, project valuations, discount rates, customer demand, hedging, regulated returns, capex economics, and the distinction between immediate and longer-term effects. Question 14. How would you analyze Iberdrola's foreign exchange exposure? I would distinguish transaction exposure, such as contracts or costs denominated in foreign currencies, from translation exposure when overseas subsidiaries are consolidated. I would map revenue, operating costs, debt, and capital expenditure by currency, then identify natural offsets and derivative hedges. I would test how exchange rate movements affect reported earnings, cash flow, net debt, and covenant ratios. Finally, I would explain that translation volatility may not equal a permanent change in local currency economics. Focus on transaction and translation exposure, operating currencies, debt currency, natural hedges, derivatives, sensitivities, earnings effects, cash flow effects, and the difference between accounting and economic exposure. Question 15. How would you investigate a significant variance against budget? I would first confirm the data and define the comparison period, then decompose the variance into price, volume, mix, timing, foreign exchange, cost, and one-off effects. For a renewable segment, I might separate lower generation caused by wind conditions from weaker realized prices or availability. I would discuss the drivers with operational owners, determine whether they are temporary or recurring, quantify the full-year impact, and update the forecast with a documented audit trail. Mention isolating price, volume, mix, timing, foreign exchange, cost, and one-off drivers, validating data, engaging business owners, quantifying recurring effects, and updating the forecast. Question 16. Which Excel techniques would you use in a financial analyst role at Iberdrola? I would build models with clearly separated assumptions, calculations, outputs, and checks. I regularly use SumIfs, XLOOKUP, index match, pivot tables, scenario switches, and sensitivity tables, while keeping formulas transparent and avoiding hard-coded outputs. For a utility model, I would include checks for capacity roll forwards, debt balances, cash flow reconciliation, and segment totals. I would also document sources and assumptions so another analyst can review, update, and challenge the model efficiently. Be sure to mention structured model design, XLOOKUP or index match, SumIfs, pivot tables, scenario switches, error checks, sensitivity tables, data validation, and clear documentation. Question 17. How would you evaluate whether Iberdrola should accelerate a renewable project? I would compare the incremental NPV and IRR from accelerating the project with the value of waiting or investing elsewhere. The analysis would include earlier generation and tax benefits, but also higher financing costs, equipment pricing, construction risk, permitting, grid access, and supply chain constraints. I would run power price, delay, and cost overrun scenarios, then assess funding capacity and strategic fit. Acceleration makes sense only when earlier cash flows outweigh the additional risk and capital burden. Discuss NPV and IRR, strategic fit, grid access, permitting, supply chains, cost inflation, power prices, funding capacity, execution risk, and comparing acceleration with alternative investments. Question 18. Tell me about a time you explained financial analysis to a non-finance stakeholder. In a previous project, I explained a cost variance to an operations manager who did not use accounting terminology. I translated the result into 3 operational drivers: lower output, higher maintenance rates, and timing of contractor invoices. I used a simple bridge, separated controllable from uncontrollable items, and confirmed the manager's understanding before agreeing actions. That approach produced a more accurate forecast and improved accountability. I would use the same practical style with Iberdrola's operational teams. Focus on simplifying technical analysis, understanding the stakeholder's decision, using relevant operational drivers, communicating assumptions clearly, checking understanding, and ending with a practical recommendation. Question 19. What would you do if a senior colleague asked you to change an assumption without support? I would ask what evidence supports the requested change and understand whether it reflects new information, a methodological issue, or an attempt to improve presentation. I would document the original and revised assumptions, quantify the effect, and show sensitivity where uncertainty remains. If the change lacked support, I would respectfully explain the risk and follow the appropriate escalation process. Accurate, transparent analysis protects management, investors, and the company, so I would not compromise reporting integrity. Mention professional skepticism, evidence, transparent documentation, respectful challenge, sensitivity analysis, escalation procedures, confidentiality, and protecting reporting integrity without becoming confrontational. Question 20. Why do you want to become a financial analyst at Iberdrola? Iberdrola appeals to me because it combines renewable generation, electricity networks, international operations, and substantial long-term investment. That creates a demanding analytical environment where forecasting must connect operational drivers, regulation, financing, and sustainability. I would bring strong financial modeling, attention to detail, and a willingness to understand the underlying business rather than simply report numbers. The role also offers the opportunity to support projects that expand clean energy infrastructure while developing broad utility sector expertise. Be sure to connect Iberdrola's renewable transition, regulated infrastructure, international scale, capital intensity, analytical challenge, sustainability goals, and your own skills and career motivation. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.